Welcome to the Wealth Studying Podcast. This is episode 489. Today is August 21st, 2025. I'm your host, John Pagliano. I'm also the founder and money manager at investablewealth.com. Lots of market volatility right now. I'm not going to comment. I'm just watching it. A lot of talk about buying the dip. The question always is, how deep will the dip go? The media headlines are all abuzz about the tech stock sell-off or the collapse like they're calling it. Well, pull up a chart of the NASDAQ. It's only had the last 2 or 3 sessions where it's dropped below its short-term moving average, and it's still not even resting or bouncing off of its 50-day moving average yet. So I would hardly call this a meltdown. And in fact, pull up some charts of the Dow or the S&P 500 and you'll see they're holding up even better. In fact, the Dow is really staying above its short-term moving average. That's in spite of a bad profit miss today on Walmart, which makes up a pretty good component of the Dow. And what I find even more encouraging is if you look at the broader market, especially the S&P Mid-Cap 400, which is the profitable, kind of best performing blue chip mid-cap stocks, they've been in an extremely good recovery since the April lows. But if you zoom out and look at a big chart, you'll see that they're really just at the buy point of a consolidation from a long-term chart pattern that I refer to as a hook and barb. That index peaked after the November elections and is still below that high by, 7-8%. So when you hear all the media drama about a sell-off and this and that, listen, I'm ignoring it. I've got cash on the sidelines. I'm ready to come in and buy a dip on, but I'd certainly like to see a dip better than what we have now. And in fact, I've already digressed. I don't want to go down that path. I want to talk to you today about Warren Buffett, his Berkshire Hathaway, and how they're continuing to sell their shares of Apple stock. And what I want to point out here is just as I'm ignoring the media about their frenzy on this current sell-off, I'm also ignoring the media when they tell me that just because Berkshire Hathaway or Warren Buffett or anybody else is selling something that I should sell it too. Or just because Berkshire Hathaway is buying United Healthcare, I should buy it too. Well, listen, I already own United Healthcare. It has nothing to do with Warren Buffett or Berkshire Hathaway or anybody else. And when it comes to selling Apple stock, the fact that Berkshire right now is continuing to sell off their position in Apple has no bearing on anything I'm going to do. And I'm going to tell you right up front, I'm not a fan of Apple short term. I don't want to buy or own Apple right now in this current environment. And my short-term disregard for Apple has nothing to do with the media's supposed claims that Apple's lost its mojo and can never catch up with artificial intelligence, or again, anything that's in a 13F filing or a Form 4 filing from Berkshire Hathaway or Warren Buffett or from anybody else. My concern about Apple stock short term is what I see with my own eyes, and there are 3 distinct problems. You can sum them all up by saying China, China, China. First off, and Apple isn't alone on this one, you can put it in the category of Tesla and Starbucks and just about any other large multinational company that's gone into China in the last 30 years thinking that they're going to tap into the immense 1.4 billion consumer market. Well, it never happens. Or better said, it happens to a point. But once those entities get too large, the Chinese Communist Party and the state-owned enterprises come in and either sabotage the brand or the company indirectly, or they simply substitute it with a homegrown product or service. Again, this is not unique to Apple. Take a look at Starbucks' position today and what they say on their expansion into China versus what they were saying pre-pandemic. So first Chinese problem, Apple, like all these other multinationals, are not going to grow the Chinese domestic product any further than they already have. And that was a large part of their future growth strategy. So that's out the window. Next China problem, too much dependence on Chinese manufacturing. Again, like most, if not all, multinational companies that have a product that can be made in China. They do, and they've hurt themselves for it. Apple, in particular, probably like no other company, has moved the greatest amount of technical knowledge and know-how into China over the past 25 to 30 years. They've created an ecosystem like the Hotel California. They can keep saying that they're going to check out and go to India or go to Vietnam or come back to the United States, but they can check out all they want. They just can't seem to leave. It's estimated that Apple manufacturing in China directly, at a minimum, employs at least 3 million people. Now, when you include a whole universe of supply chain involved in that, it's probably 10 times that many people. This has worked well for Apple over the last 30 years, but it's coming back to bite them now. And if for no other reason, because of all the geopolitical confrontations and tariffs and supply chain disruptions that aren't going to get any better. And that's the good side of it, because if China ever really wanted to hurt the U.S. consumer market or the U.S. technology markets, they wouldn't cut off rare earth magnets like they did. I mean, that has a strategic impact to the United States, and it's definitely a road bump or a hurdle to the global high-tech economy. But the reason Chinese put export restrictions on rare earth magnets is because it would hurt the U.S. and the West more than it would hurt China. China doesn't have 3 to 30 million people in the rare earth magnet supply chain. They do have that many people related to Apple manufacturing. So for now, the Chinese hurting Apple manufacturing is somewhat unlikely, because it goes back to that old Cold War saying of MAD, mutually assured destruction. If China cuts off Apple manufacturing, sure, it hurts Apple. Yes, it hurts the U.S., but it hurts China as well, and so they're less likely to do it. But either way, China problem number 2, over-reliance on manufacturing in China, is a big problem for Apple. And then finally, Chinese problem number 3, related to the 2 previous China problems, Chinese competition to Apple, not only the iPhone, but all of Apple products and technology. And whether it's Huawei or some other state-owned enterprise or a component of the Chinese Liberation Army, being redundant here, but whatever the source of Chinese competition against Apple, they are eating Apple's lunch. And again, this is because not only has Apple set up this ecosystem over the last 25 or 30 years of this manufacturing and technology excellence in China, but the Chinese competition has taken that knowledge, either fairly or unfairly, and created as good or better products. If it weren't for the fact of national security and industrial policy and the very real paranoia about Chinese Communist Party, other bad players having a backdoor built into the Huawei or other technologies, if it weren't for that, Huawei and these other companies would already probably have demolished the smartphone market, much like they have solar panels or lithium batteries or, name what other targeted source you want to. But again, the bright spot in this, at least long term, is that I think we've hit a low in moving manufacturing to China, whether that's Apple or anybody else. And when it comes to big key technologies, critical infrastructure, and manufacturing ecosystems, that the United States specifically and the West generally are going to put in place national security policies or trade restrictions or sovereign wealth funds or industrial policy, call it whatever name you want to. But these homeland type security national defense issues are going to help companies like Apple long term. Now, after that very long digression, while I'm on that, let's go one more thing. The media is telling you not to invest in Apple because they've just totally lost their way or any competitive advantage in artificial intelligence. Could be true. Listen, I certainly have never liked or relied or even used something like Siri. I thought it was always clumsy and not convenient or accurate. The only time I've ever used something like Apple Maps is when I was lost. And I was lost because I used Apple Maps by accident instead of using Google Maps, because it always takes me to the wrong place. So I'm not here to tell you or defend Apple to say that they're going to have any more success with artificial intelligence than they've had with their Maps or Siri. But what I do believe, or what I know, is that Apple isn't an innovator. Apple never invents anything. Not the PC, not the smartphone, not the laptop, not the tablet, not the MP3 player, not earbuds, not watches, right? They don't invent any of those things. They come into these markets and they make them better. And so, again, long term, I feel pretty confident that Apple will find a way to put a better user interface onto artificial intelligence, at least to the extent that it's used on their devices or platforms. I think they'll figure that out. And if they let these other people spend vast sums of money hyperscaling up to that level, so that Apple can then come in and pick the low-hanging fruit after everybody else has been on the bleeding edge of technology, then I think, hey, that's even better for Apple. But we shall see. In any case, after all these long digressions, let's get into specifically Warren Buffett or Berkshire Hathaway's long-term selling off of Apple. It's been going on for about a year and a half now. And why is that not a cause for concern, at least not for me? Listen, people sell things for a multitude of reasons. But broadly speaking, it falls under two categories. There's a market strategy, I'm talking about a stock market strategy, where you would sell a company's stock if you think that that stock is either going to be stagnant or if the price is going to go down. That would be a marketplace or a market dynamic type strategy. And if that were the case, then yes, I would want to sell Apple stock. But I don't think that's why Berkshire Hathaway has been selling Apple stock for the last year and a half. I don't think it's about market strategy. I think it's about portfolio strategy, or more commonly called portfolio management. And portfolio management is specific to the person that owns or runs the portfolio. Just like beauty is in the eye of the beholder, why someone would choose to sell or buy something to rebalance or to diversify or to concentrate their own portfolio has absolutely no reason as to why anybody else in the world would be interested in buying or selling that stock. Pure and simple, what I'm saying is, even with a company as large as Berkshire Hathaway, just because they choose to buy or sell something specifically for the purpose of balancing or readjusting their portfolio has little long-term impact on the market. Or even short-term impact for that matter, because they're not stupid. They don't go sell everything at once. Over the last 18 months or so, Berkshire Hathaway has reduced their Apple holdings by about 70%. 70%, that's a huge number. When Berkshire Hathaway started exiting their way overweight position in Apple, it was somewhere around, the end of 2023, at least sometime fourth quarter 2023. So again, about 18 months ago, roughly. At that point, Apple was at a record high. And even after that huge exit, not only reducing their position now by 70%, but having it as public knowledge that they were doing it quarter after quarter after quarter, Apple still went on to put in another all-time record high multiple times, but culminating just at the end of 2024. So a full year into the divestiture of Apple stock by a major holdings like Berkshire Hathaway, and the stock price still went up probably, more than 25% over that same period, when people knew that Berkshire Hathaway was actively divesting from the company. So again, just because a big guy like Berkshire or Warren Buffett reports on a 13F filing or a Form 4 that they're selling a stock, it doesn't mean that that price won't continue to go up, which means that you may not want to sell it just because someone else is. And even with Apple's pullback this year, again, mostly on the fact that people think it's losing its way in AI and nothing to do with the big divestiture from Berkshire Hathaway, the stock is still up more than 10% from when they started selling it back at the end of 2023. And I'll reiterate here, I don't think that Warren Buffett or Berkshire Hathaway has been selling their Apple position because they think that Apple's going to be an underperformer long term. I think it's simply portfolio management or portfolio strategy where Apple had become too much of a concentrated position in their portfolio, well over 40%, I think even maybe close to 50% at one time of their overall equity portfolio. That's too much to have, your eggs in one basket. And even after the major reduction that they've had over the last 18 months, Apple remains the strongest or the highest percentage holding in their equity position. And it's still by probably, not quite twice as much as the other holdings, but it represents, I think, a good 25% of their portfolio, 20 to 25%, where the second or third level position, is only maybe 10 or 15%. So I think that Berkshire Hathaway over the coming quarters, you may see them continue to sell Apple, or maybe wait a little bit until the price stabilizes and then sell more of it. But it's not because they don't think Apple's going to continue to grow. They're just trying to risk mitigate their portfolio. And if they were to take Apple down to just say under 15%, probably closer to 10%, they're going to sell off a whole lot less than they already have. And since I've already pointed out that their long-term divestiture here has really not had an impact on the stock, that every time you hear someone in the media telling you that Warren Buffett is selling Apple, well, you should just ignore it, because that has nothing to do with the likely outcome of the stock price in the future. And I do think they're going to settle in at maybe 10 to 15% holdings of Apple. And how long could they hold that? Well, let's look at one of Warren Buffett's favorite companies, Coca-Cola. That's about a 10% equity holding in Berkshire Hathaway portfolio. And they've owned that stock for like 35 years. And what I'm describing to you right now is no different than what you heard me talk about a couple months ago when I exited my position. Let me restate that. I almost like the media said it wrong. I reduced my position in utility stocks. I was way overweighted in utility stocks. I sold a couple of them outright. That left me with, more than a dozen utility stocks remaining in my portfolio, and with decent sized shares in them, to where I was still, in terms of the S&P 500, way overweight in utility stocks. But I was, from a risk mitigation standpoint, significantly less than I had been over the previous year, where I had been building up in them, and not only had I bought into them, but they appreciated to where they became over, 30-35% probably of my overall portfolio. I sold a large number of those shares. I took profits, but I'm still a believer in utility stocks, and I'm still heavily invested in them, even though I sold off more than I own now. And so, in somewhat of a twisted way, this brings me around to make the point that in terms of a cash position, my portfolio is not that much different from Warren Buffett's. It's reported that overall, not just the equity position, but Berkshire Hathaway's overall ownership of both publicly and privately traded companies, that they're about 30% in cash. And you constantly hear in the media that obviously must mean that Berkshire Hathaway and Warren Buffett are paranoid about the future, and they don't want to own stocks, and they can't find good deals or discounted, value stocks to buy. Well, is that in fact true? Because look at me. I'm sitting 20% in cash, more or less. So not quite 30, but still a lot more than, I would say, vast amount of active money managers. And yet, am I paranoid? Am I concerned about a recession or a drop in the stock market? No, I'm about the most cynically optimistic, long-term bull that I think you can find right now. And yet I'm 20% in cash. I'm 20% in cash because I'm simply rebalancing my portfolio. I've taken profits, and I'm eventually going to deploy that money back into the market, just like at some point Berkshire Hathaway's will too, whether they buy directly into publicly traded equities, or whether they reinvest in their current private businesses, or whether they buy additional private companies. And for that matter, for everybody thinks that Berkshire Hathaway is so negative on the economy and this and that. Do you know what they're invested in with that 30%? Short-term treasury bills, which kind of gives you an indication that they must not be too overly concerned about runaway inflation or hyperinflation or stagflation or any long-term deterioration of the status or the value of the US dollar. So take that for what it's worth. As always, until next time, this is John Pugliano wishing you the very best returns.